Good morning, everybody. This is Patrick MontesDeOca live trading here at the Equity Management Academy live trading room. We have a considerable amount of volatility this morning. The silver market in particular has made a high at 26.49.50, and it's come down in the last half hour down to about 26.16. It's up again to 26.30. So we have a great deal of volatility in precious metals. The gold market is $19.96, up $21, $22. So we've crossed once again the $2,000 range in the gold market, and in silver close to $26.50. What I would like to do on the segment here is to share with you pretty much some of the fundamental news that are going on in the market right now with regards to Ukraine, with regards to the situation there that is exacerbating the supply chain. I want to refer to an article that was written in Zero Hedge over the weekend entitled Ukraine War Revives Supply Chain Crisis. And it's an issue that seems to be building up a lot more attention, and it should get a lot more attention in the media than it is getting. And I just want to refer to a couple of points here that are very, very important to the European economy, to the US economy, and to the whole economy globally, basically, with regards to supplies. Europe depends on Russia, Ukraine, and Belarus for its energy imports, but also some chemicals, oilseeds, iron, and steel, fertilizers, wood, palladium, and nickel, amongst others. Especially the energy dependency is a vulnerability now that Russia is demanding ruble payments for its exports. It is unlikely that Europe would be able to fully replace Russian gas in the short term, whilst most of the Russian oil in solid fossil fuels could be replaced. Besides energy goods, disrupted supply of pig iron and several other iron and steel products, nickel and palladium, will likely have the largest impact on the EU industry. EU supply chains could also be distorted via related production disruptions on third countries. The EU could face challenges in importing, e.g., electronic circuits from third countries, as this requires inputs such as nickel and neon gas sourced from the war zone. Germany and Italy are relatively vulnerable to the crisis because of their relatively large industrial sectors, strong reliance on Russian energy, and in case of Italy, strong reliance on Russia and Ukraine for certain iron and steel imports and gas to its total energy mix. Will we ever catch our breath? Just as supply chain issues caused by the pandemic were starting to ease, the next crisis has presented itself. The war in Ukraine is making clear that large parts of the world depend on Russia, Ukraine, and Belarus for basic necessities such as food, energy, and other commodities. Trade with Russia, Belarus, and Ukraine, referred to as the war zone in the remainder of this piece, has come close to a halt due to wide range of sanctions, self-sanctioning mainly by Western companies, and strongly disrupted production and transport in Ukraine. Although the overall share in the world trade is limited for those countries, trade disruptions can have large implications for both specific firms and industries as well as entire economies. Disruptions, both actual and feared, to imports from the war zone will hurt the EU more than less exports to the war zone. Not only because the war zone accounts for a larger share in the EU's imports than exports, but especially because less imports of commodities and intermediate products can be knock-on effects on multiple production processes in the EU. On top of oil and gas, Russia, Belarus, and Ukraine are producers of a number of key commodities that are used in everyday items or in the production thereof, such as pig iron, palladium, and neon. Apart from food products, the EU extensively depends on the war zone for several energy goods, chemicals, fertilizers, and metals such as iron, nickel, and palladium, once again. So what I'm trying to point out here, and you can take the time to read this article on your own here on Zero Hedge, but this is bringing in a tremendous amount of pressure, once again, for prices, for the inflation factor that is really at record levels here in the United States and in the Eurozone. One of the things I want to do here is bring in China into this discussion here, because China's COVID policy locks down a city 3 times the size of New York, Shanghai. For a sense of the economic scale in China's latest COVID lockdowns, look at the numbers in Shanghai. In terms of U.S. states, Shanghai population is between that of Florida, 21.8 million, and Texas, 29.5 million. Shanghai is home of the world's busiest port, followed by Singapore, according to Bernstein. So we have a building problem developing from China as they had closed all their ports. And this is a pretty serious lockdown in China. And I believe it's going to have tremendous impact additionally to the supply chain. China's lockdowns could trigger a logistics snarl that may dwarf 2020 and 2021. Many goods are stuck in China at the moment in a big problem booming for the global economy, says IMA Asia's Richard Martin. In the last few weeks, China has been battling its most severe COVID outbreak on the mainland since the initial shock of the pandemic in early 2020. We have to take serious consideration to what this could do to the Eurozone as the Eurozone basically depends on Russia and Ukraine as the breadbasket of Europe. And not only the Eurozone, but also third world countries, Africa, are going to be experiencing potentially famine. We continue to see articles, analysis on China's widening COVID curves threaten global supply chain paralysis. I think this has some real deep ramifications economically. And what I want to do is I just wanted to put this fundamental analysis that we're dealing with right now into the table, so to speak, and take a look at the fundamentals perspective and see how the markets are reacting to it and how we can take advantage of the situation here as traders, as individual, self-directed individuals, and simply a way to monetize out of the situation. The 10-year note is trading at 283. And we have seen a pretty sharp rise here in a short amount of time. If you just go back to 2020, we had a low of about 0.33%. And in 2 years, we've risen out to 2.83%. And the indications seem to be that the 3% yield is in the cards as we continue to see this supply chain situation increase and worsen, you might say, as we move further into 2022. The situation basically is a pretty, I would say, serious situation that we had to take into consideration, because the inflation rate that we are running here in the States is you're looking at 8.5%. And when you got even the 10-year note trading even at 3%, you're looking at a 5.5% negative yield. Now, this is the inflation level that U.S. government is publishing. And year over year, I believe the CPI is running at about 11.2%. Shadow Stats, which uses the 1970s formula to identify inflation, is looking at inflation to be at about 16%. The real inflation. So we're running a real negative yield on the US dollar. And this is coming in really on the face of this geopolitical crisis at the same time that we have a $30 trillion debt. And the pressure coming from inflation trading way above the levels indicated by the, you might say, criteria required by the IMF to have a normal economy. And that is essentially that rate should be 1% above the inflation rate. So if we're looking at 8.5% or whatever you're looking at, 8.5 or 12%, rates would have to go up 1 point higher than that in order to be normalized. And I believe sincerely, if that was to happen, we would see the global economy collapse. There's no question in my mind. So it's a very tricky situation how the Feds handle this crisis. If they raise rates too fast, too aggressively, they stand to pretty much kill the equity markets. They have been providing some sort of protection, some sort of put against stocks since 2020, when we got hit with the pandemic, and obviously they opened the printing press, as you might say, and have printed in excess of 10% of GDP, which was already anticipated when they decided to open up the printing presses. So we have seen a tremendous decline on the US dollar when you really think about it. Even if assets are increasing here, like real estate, if we've seen a drop in the US dollar of 30%, well, the asset should be equal to that on the other side of the coin and be up 30%. So you're not really making any money. It's simply a dollar or a currency weakness that's occurring. And this is where we headed here, basically, is that the situation in Russia, the Russia invasion, is not going to end anytime soon. There seems to be some clear objectives in Putin's invasion, and it's pretty clear that he's concentrating in the area, the southeast area, which is really the second largest natural gas producing area in the world. The Sea of Azov, the Black Sea, that whole area is so critical to the economy of Ukraine. And if they are able to blockade that whole area, we're going to see, again, massive supply chain disruptions. Not to mention the planting season that has been affected by this war. So some of the numbers that are coming out are indicating that Ukraine is going to lose about 17% of their planting season, and that's just the beginning. So let's take a look and see pretty much how we're taking advantage of the situation. One of the things that I do here is I use the VCPMI, which is the variable changing price momentum indicator that uses standard deviation and mean reversion trading principles to capture and identify the extreme levels of the market in terms of speculation for the day, primarily for day trading. For example, here we focus on silver, and we see that the high was made at 26.4950 early this morning at about 4:30 a.m. The numbers that you see, the sell to 26.47 was a daily number anticipated as a target as we came into today, or Sunday night for Sunday's night's trading. So the VCPMI identified the extreme level above the mean of the standard deviation, which is 2 standard deviation, and has completed the first target. When the price reaches this level, you take a profit, you go neutral, and if it closes below, it activates another short. The target is the level below, which was completed, 26.16, from a short of 26.38. It's perfect trade. Now, where we are right now, and I'm showing you, we made $325, and we're flat now on the day trade. And I'm pretty much watching to see the price action, how it resolves into this area that the VCPMI has identified as an area of resistance, an area where you can see sellers come into the market. What it's called is distribution of supply. This mathematically is the extreme above the mean where you can expect supply to come into the market. These are the levels that are the highest probability. The sell 1 level is 90%. Sell 2 level is 95% probability that if sellers bring this market underneath this price after completing the target, more than likely you're going to get selling into the market, as you saw here. So we are trading in that range, and we are trading below the weekly now sell level of 2638. So if you are looking at the market, the signal is short unless a close above 2638. That is the stop. If it closes above, it neutralizes the signal. And the target that really is open for the weekly signal that's activated is 2559. What we have seen here, focusing on silver, is that the signal unfolded as expected, the momentum unfolded as expected, and completed the target. This is a momentum-driven algorithm. And we use, again, these price levels, which are pivot points that are ignited into probability models, probability levels that incorporate where the targets are located and also where we want to take profits. So the silver market is warning you to be careful up here. It's a short weekly. The stop is 2638. The target is 2559. That is a pretty defined metrics. Let's take a look at the gold market. We made a high of 2003 early this morning. And we are trading above the daily resistance level of 1996 and also above the weekly sell 1 level of 1994. The next target activated is 2012. The price is entering the area of distribution of supply, and it is now under support levels. When the resistance is broken, it becomes support. And the target activated is 2012. You can use 1936, a close below 1936, to protect this position. Or the weekly 1994. Because if we close below 1994, we're going to be closing a weekly short trigger, activating a weekly short trigger and a daily short trigger. So it's going to be a pretty strong signal if we close below 1994 in the gold market. Bitcoin made a low of 38,535, not quite coming down to the weekly buy trigger here at 38,468, but found buyers higher, activated a daily buy trigger here, and now we're in a bullish signal with the targets of 40,330 and 40,637 from these levels here. This is the way that basically I trade and I execute this fundamental information here that we are dealing with right now. And you want to understand that sometimes the markets don't react exactly like the fundamentals, like the news, like the headlines. And so you want to use a way, a system, a metrics that works for you. And this is what I'm doing here. This is what I teach in my live trading room in Discord. I want to wish everybody a great week. Be safe. I'll talk to you soon.